Hello, everyone, and welcome to this month's Investor Academy session on the EIS and SEIS tax breaks. I'm Sarah Turner, and I'm joined as usual by Angel Academy co-founder Simon Hopkins and our network manager, Michelle McQueen. And of course, our brilliant speaker this evening, Mark Pattenden, who's tax partner at haysmacintyre. As usual, to talk to us and ask questions, please use chat. Before I introduce Mark, just a little bit about us, also as usual. So Angel Academy exists to close the gender gap in startup investment. That's both the lack of investment going to female founders and the low number of women participating as angel investors. We've been doing this since 2014. We've seen many thousands of pitch decks in that time, and our members have invested in 47 businesses so far, many of them through multiple rounds. So we have more experience than anyone else in female investment in the UK. So do we still need to talk about gender? Sadly, yes. So investment still lags behind entrepreneurship. Women are now very well represented in high growth entrepreneurship. 26% of businesses have a female founder, co-founder, according to Bohurst, and that's from their specific focus on high growth entrepreneurship. So this is businesses that come out of universities as spin-outs out of accelerator programs, recipients of Innovate grants, and recipients of equity investment as well. But 87% of all funding in Europe still goes to all male teams. And although women in the UK own half the net wealth, we're only 14% of angel investors, and only 7% of us have invested in 10 or more businesses, many of them as part of this network. So we invest less often, and female ticket sizes also tend to be much smaller. And then on the VC side, in European venture capital, it's men that still control 91% of all the money invested. So what are we doing about this at Angel Academy? Well, we've been calling out the disparity for a long time and are proud to have helped change the conversation around it. But our real focus has been on action, not words. Our angels, I mentioned before, have invested in 47 deals through Angel Academy and mobilized well over 100 million in co-investment. These companies now employ going on for 1,000 people in high quality jobs, and many of them will be women. They generate multi-millions in revenues, and many have a social purpose at their heart of their mission. So diversity, obviously, but better healthcare, lower environmental impact, improved education, and so on. So we're addressing many of the UN Sustainable Development Goals through members of our portfolio. And last but not least, we're very proud to be on Bohurst's list of most active angel investors in the UK, and we're the only diversity-focused network on that list. So what's our offer for investors and founders? Well, Simon and I are both angel investors ourselves, and when we set up Angel Academy, we wanted to create an angel network that worked a bit better, worked better for new investors who would be supported. They'd be able to co-invest alongside experienced investors, experience benefit from other areas of expertise, where we could do thorough due diligence but save time by sharing the work, where we'd be respectful of founders. Their time in particular is precious, and they deserve decent sized checks, which is why we've set our investment minimum at £10,000. We're transparent and considered, and our track record of successful investment creates a very high quality deal flow and a high volume of deal flow as well. It's vital in this market that you see lots and lots of deals. We're extremely lucky to have some great sponsors supporting our mission. They advise us and the founders we back on recruitment, on deal terms, next stage investment, and tax and accountancy. If your company would like to get more involved, please let me know. But back to this evening's fun. I'm absolutely delighted to introduce Mark Pattenden, tax partner at haysmacintyre. He's been advising us on EIS for 7 or more years, so he's really one of the leading experts on the subject. I've got a few questions for him to kick off the conversation, but we'll have plenty of time for your questions as well, so please put them in chat as we go along. So, Mark, do you want to come up to the stage?
Hi, Sarah. Hello.
Hi. Right. Lovely to see you. How are you today?
I'm very well, thank you. How are you?
I'm very well as well. Yeah. Enjoying the sunshine.
It's clouded over here in London. It
Oh,
was sunny
right.
earlier.
Okay. It keeps coming back. So fingers crossed. So just to kick off on the questions very, very quickly, what is SEIS and EIS?
Well, EIS and SEIS, effectively they are the seed and enterprise investment scheme. They are tax incentives provided by the government to encourage investors to put their money into and support early stage companies and allow them to grow.
And it really does drive early stage investment in the UK. I think it's about 2 billion a year is invested by individuals under EIS. 85% of UK angel investors use it. It's a really, really unique and very valuable advantage. So talking about entrepreneurs first, what they need to do to get ready to fundraise?
Well, the EIS process is really led by entrepreneurs. So the first thing that a company needs to do is assess whether it's actually eligible for EIS status, and that's effectively to make sure that it's operating a qualifying business, and we'll come on to what those are a bit later.
Hay fever.
Oh dear. And then to effectively the best way is to apply for what's known as advanced assurance, which is a process whereby the entrepreneur gives a whole load of details to HMRC and asks HMRC to give clearance that they would be a qualifying company if people were to invest in them.
Okay, so we'll come back to eligibility criteria, but just this advanced assurance piece first. If it's their first fundraise, entrepreneurs will need some initial interest before they can apply for advanced assurance. Is that correct?
Yes. HMRC used to be inundated with applications for EIS from many companies that never actually raised any money, and this was obviously causing a backlog in the system. So what they've introduced now is expressions of interest. So a company, when it applies for EIS advanced assurance, has to give a demonstration that it has a handful of investors who are prepared to invest in their company. Now, it doesn't mean to say that they have to follow through on that, and it also doesn't mean to say that anybody who hasn't been included in that initial expression of interest, they're not precluded from a fundraise later on. It's just to signify that this is a serious and a genuine investment opportunity.
Okay, so handful, 4 or 5 investors, it's enough, it's name and address, it's not a commitment, it's just an expression of interest.
Absolutely.
Brilliant. Okay. And so we're only investing in SEIS and EIS qualifying companies at Angel Academe, but what are some of the reasons a business might not qualify? What's excluded?
Well, there's a few things. First of all, the company might be too large, in that it can't have assets of more than 15 million. It might be that it's too old. You can only apply for funding under EIS if it's within the first 7 years of the company's first commercial sale. Another reason that it might have already received more than £12 million worth of EIS funding in the past. But fundamentally, probably the biggest reason that a company wouldn't qualify is that it's operating what's known as an ineligible trade. Now, these are generally professional services, so accountants, lawyers, property development can be allowable. Property investment certainly isn't. Regulated banking and financial services, so insurance, operating a bank in itself, are also ineligible businesses.
Okay. And just to sort of go a bit deeper onto that, we've invested in several fintech companies. They provide services rather than banking per se. So Fiscal, Muse, Scale, XP, and they qualify, right?
Yeah, absolutely. They're effectively they're software as a service companies, and that's absolutely fine. They might be operating in the financial services sector, but they're not running regulated financial services, which would be prohibited. So yeah, they're fine.
Okay. So we've established that a company is EIS eligible, amongst other things, in our due diligence, and we've made our investment. What's then the process for us investors for claiming tax relief?
Well, the process is, as I say, it's very much company led. So once the investment has been made, it's down to the company to send in an application to HMRC for post investment clearance. Now they need to give HMRC the details of the company, of the investors, how much they've invested, what the money is going to be used for, and a whole load of details like that. Then, assuming that the company is eligible, and yeah, if they've got operated on pre-clearance, then that's usually quite a good sign. That'll speed up the process. Once HMRC is satisfied that it's a qualifying investment, they will write back to the company and giving them permission to issue the certificates, which are known as EIS SEIS, which the company then sends out to its investors. And it's once you've got this EIS 3 certificate that you're allowed to claim the tax relief, and you're safe in the knowledge that you have made a qualifying investment.
And then we had a chat about this previously, but quite often it takes a while for founders to raise their full round. So they might have some EIS investors who invest in 1 month, and then others who invest in later on. Do they need to wait for their full round to close before applying for EIS certificates for the investors that have already completed? And what's the rule of thumb here?
They don't. They tend to, though, is the practice, because obviously an application is time. It costs time and money. So what entrepreneurs will generally do is wait until they've got all of their investment round secured, and then submit their EIS claim. So yes, it can take some time, particularly if you're one of the earlier investors in a particular round, and it's and one of the negotiations is taking a little bit longer than you're happy with. The key thing is for entrepreneurs to keep investors informed. Investors can't claim the tax relief until they get that certificate. The certificate takes time. It is led by the entrepreneur themselves. It's down to them to make the application. If there's going to be delays, just keep the investors informed, I think is the key point.
I think that's absolutely vital. I think that founders perhaps don't realise the urgency, but we've got plenty of investors who literally 7th of April, they're working on their tax return for it's their cash flow, isn't it? So it's vital. And then when can you make your EIS claim? We just mentioned that you need the certificate first.
Yeah. So once the certificate's been received, there are you've got several options in how to make your claim. You can include it on your tax return for the year that you make your investment. You can also submit a standalone claim. If you want to carry the investment back, you can effectively amend your tax return from the previous year. And this might be dependent on when you had income, when you had tax liability. So it's down to you to either put it on this year's return or put it onto last year's return with a standalone claim that you can fill in the form on that is attached to the EIS 3 and submit it to HMRC.
Okay. And are there things that we as investors need to do to make sure that we're eligible?
Well, it's not necessarily about the investor being eligible, it's whether it's worthwhile. So the key point, the one thing that I always drill home to investors is to make sure that you've actually got a tax liability. Because this is an investment that is not led by the tax relief, but the tax relief plays a significant part in it. If you are claiming, if you have an income tax liability, then you effectively can claim 30% or even 50% if it's SEIS of your investment against that liability. And once you've made that investment income tax relief claim, then any subsequent growth and capital gain from the EIS investment is tax-free. But if you don't make that income tax relief claim, if you haven't got any income and tax to set that initial investment against, you won't get the tax exemption on the subsequent exit. And that's really what everyone's hoping for with an EIS investment is the X times investment that will be the capital gains tax-free incentive at the end.
Okay, so before we talk about upside, I'd like to talk about the downside protection that EIS offers. So what percentage of an investor's investment is actually at risk?
Well, as I said earlier, the income tax relief and income tax return that you get is 30% immediately with EIS and 50% with SEIS. So you can already see with an SEIS investment, you get half of your money back before you've even started. Income tax EIS, it's 30%. With the potential of claiming loss relief as well, if the company goes bad, higher rate taxpayers can actually protect 60 to 70% of their investment with various tax reliefs. So you've de-risked to 30 or 40%, and it's by far the most, I hesitate to use the word secure, but de-risked investment opportunity that there is.
Right. Okay. So if things go wrong and the company that you've invested in does fail, what's the process for claiming this cross loss relief?
Again, what you've realised is a capital loss, but because of the technicalities of the tax rules, the capital loss can be converted into an income loss. So you, rather than getting 20% capital gains tax relief, or sheltering capital gains that would be taxed at 20%, you can actually use the loss that you've incurred against your income and potentially get 40 to 45%, depending on what your marginal rate of income tax relief is. So it's a claim that you would make through your tax return when you put the capital gain, the capital loss on the CGT pages, and then you claim, you tick a box on that return and it converts it into an income tax loss.
And what evidence do you need to support that claim? Generally,
the principal evidence is the company going into liquidation. So the company has gone into members' voluntary liquidation generally. There's no prospect of a return coming back from the company. It's being struck off. I've lost all of my money. Thank you very much. I will make the claim. The difficulties get into when companies go into administration, or if they just stagger along, not really doing anything. You can, in those circumstances, you can make a negligible value claim, which effectively says that the company has become worthless, and therefore there is no prospect of a return. And those are slightly more technical claim. You'd need to check the circumstances. If there genuinely is no prospect of a return, then speak to your financial advisor, speak to your tax accountant about the prospects of making a claim in those circumstances.
And there are documents submitted to Companies House that we can download and use to support our claims, isn't it?
Certainly, as far as the liquidation is concerned, formal papers have to be filed at Companies House to indicate that liquidators have been appointed, the company is going into, it is being struck off. Those papers are all open source. They're available to download from Companies House. As I say, the difficulty becomes, or the more complex situation is where administrators are appointed, which isn't necessarily a sign that the company has failed. It's just that it's in difficulties. There are different circumstances. So yeah, those are the ones where you might need to take further advice.
So obviously, we hope that in our portfolio of angel investments, some will sell for far more than we paid for them, and we won't have too many losses. So what are the upside protections we get from EIS?
Well, as I mentioned earlier, the biggest upside is capital gains tax exemption. So if a company sells for 5, 6, who knows, 10 times the original investment, providing you claimed the income tax relief on the original investment, and providing you've held the shares for more than 3 years, then the gain that you make will be completely exempt from capital gains tax.
Okay, all right. And there's a 3-year holding period, isn't there, to qualify for this?
Absolutely.
If you have a big exit, but it sells quickly, you will have to, it'll be treated as if it's never qualified for EIS.
That's right. Entrepreneurs should be aware of this. So they should be taking into account as part of their exit strategy that EIS investors will be expecting to hold the shares for 3 years. Now, obviously, sometimes there might be an offer that's too good to turn down. In which case, if you do sell the shares within 3 years, then not only do you have to repay not only does the gain becomes taxable, but you also have to repay the original income tax relief that you got on the investment when you purchased the shares in the first place.
Okay,
the 3-year rule doesn't apply to business failure, but it does apply to business success.
Yes, so those quick exits need to be massive to
they
recoup the tax breaks.
Absolutely, yeah.
So sometimes we see much earlier stage opportunities with SEIS available. So what is SEIS? And some of the terms have changed recently. So can you just quickly talk us through that?
Certainly. SEIS is Seed Enterprise Investment Scheme, and it's for very young, much higher risk companies by their very nature. So it applies to businesses that are now less than 3 years old. It used to be 2, but that's now been extended to 3. So very little history behind them. You might argue that they don't necessarily demonstrated the traction that a more mature company would be looking for, or certainly an investor would be looking for. So in order to compensate for that greater risk, the income tax relief is 50% as opposed to 30% for EIS companies. As you say, the investment rules have changed recently. So companies can now obtain 250,000 in SEIS investment, and an individual can invest up to £200,000 into SEIS companies on an annual basis. And those both have increased by about £100,000 since April this year.
Excellent. So, you know, typically fundraisers, even first fundraisers, are more than 250,000. So we quite often see deals where there's a bit of SEIS and a bit of EIS. How does that work?
Well, it's quite common and quite and quite acceptable for a company to do both an EIS and an SEIS fundraise at the same time. The stipulation is that the SEIS fundraise has to close first, because obviously it's the seed round. But that can be a matter of days. So you could close the SEIS funding on a Tuesday and then close the EIS round on the Friday. It's not a problem at all. The allocation of tax relief and the qualifying status of the investment is really down to investor and entrepreneur negotiation. So a lot of entrepreneurs rather will offer the SEIS funding on a first come first serve basis, because they want to build up that traction, build up that fundraise, so that they can then utilize the guaranteed money that they've got to collect EIS money later on. It's also possible to do it on a pro rata basis. As I say, it's down to negotiation. The only stipulation is SEIS must close first.
Okay, and it can be as little as a day for great. That outlines the main reliefs. Can you just bring that up on screen and talk us through it briefly, because that will recap on quite a lot of what we've covered already. And then if anyone has questions for Mark, we will start moving on to those. We've had a couple already.
Okay, thanks, Sarah. Rather, hopefully a straightforward slide, but I would say that I'm an accountant, so it's got numbers all over the place. This is an example of a £10,000 investment where tax relief is either through SEIS or EIS. The income tax relief for SEIS is 50%, so immediate return of £5,000. EIS, it's 30%, so £3,000 immediate return. If the company goes bad, so let's work on a worst case scenario, and we're talking about here a 45% tax player. That's anyone now who has income in excess of 125,000 approximately. The tax relief is based on the economic loss. So for an SEIS, your economic loss is 5,000 because you've already had 5,000 in relief. So 45% of 5,000 is 2,250. Your total tax relief then, if you add in the income tax relief that you've already had of £5,000, is 7,250. So effectively, you've got 7,250 of your investment back, and you've risked and lost 27.5% of your capital. For EIS, the loss is £7,000, 10,000 minus 3. So 45% of that is 3,150. So again, you've got back £6,150, and your risk, the loss, was only 38.5% of your original capital investment. As you can see, it is a significant boost to de-risk your investment by investing through EIS and SEIS.
Excellent, thank you. So we're now open for questions from the audience, and there's 2 questions that have come in from Nikki, so we'll do one at a time. So it's a startup that's raising a first round with SEIS and EIS, but they have received 123,000 in de minimis state aid, mainly from Innovate UK grants. Does this impact on the SEIS or EIS raise?
Generally, state aid does count towards reducing the amount that a company can obtain in funding. So it is possible that the amount would be restricted. Yes, we'd need to take a look at it in greater detail. But yes, the whole EIS and SEIS funding structure is regarded as state aid because it's effectively subsidizing people's investment into a company.
Okay, and then the follow-up question, another complication, is that they're applying for another grant from Innovate UK. The grant would be under the Subsidy Act, not de minimis. So does that impact SEIS?
Oh, really
and they
getting
won't
into
know
the detail
if they
here,
win
aren't we?
until they are notified of the award in the middle of the raise. She's saying, I'm very confused. So it might be...
I think it's something that I'm quite happy to talk offline about it, I think.
Yeah, Nikki, we'll put Mark's email address into the chat if you want to contact him, because some of these things are on a case-by-case basis. So I think there's a question from moving swiftly on.
I think the only thing to say is that it's definitely something that that pre-clearance would assist with, and the advanced assurance service would be useful for.
So Susan has asked, is the loss relief based on the investor's marginal tax rate in the year of loss or the year of investment?
It's based on the marginal tax in the year that the loss arises. You may have the opportunity to carry it back to the previous year, depending on the circumstances, but it's in the year that the loss arises.
Okay. Deirdre has asked that it's only 85% of angel investors who use the schemes. What are the barriers to the remaining 15%? I think often because they don't have a tax liability or it doesn't qualify for some reason, but I don't know if you've got anything else to add.
Well, a lot of people who a number of people who might be investing might be overseas. As you say, they these funding rounds aren't restricted to the UK. EIS is available to anyone who has a UK tax liability, so that could be people who are overseas but have UK property, for example, which is taxable in the UK. Property income, so they could still benefit from it, but there might be just people who, as you say, are investing in companies that are fundraising, but themselves don't have a UK liability.
And Yiman has asked if income tax relief can be split across 2 tax years.
Absolutely. Yes, you are entitled to claim tax relief in the year that the investment is made. And the technical point to look out for that is it's the year that the shares are issued in, not necessarily, if you pay the money in March, but the shares aren't issued until April, then the tax year could possibly have ticked over by that stage. So it's the year that the shares are issued in, and you have the opportunity to carry that back to the previous tax year.
And can you carry some back, but not all of it? Yeah.
Absolutely, you can apportion it. You can apportion it as appropriate, and we quite often will for clients, because what you want to make sure is that you're making effective use of their tax liability. So some people might be that the year that they're making the investment is a year where they're taking a career break, or they've cashed out of their business, or they've retired. Their tax liability isn't too high in the year when they're making those investments. So what we do is we soak up that year's liability with as much relief as necessary, and we carry the rest of it back to the previous year. So absolutely, you have complete freedom in when you in which years you make the claim.
Okay, all right, thank you. And then sort of question that comes up quite often is around what involvement with the company can you have and still remain eligible for SEIS and EIS, because it's not completely straightforward, is it?
Well, the basic rule of thumb is 30%. So you can't get tax relief if you own more than 30% of the shares. And then that is 30% with your spouse, your parents, grandparents, children, etc. But also once and you can't be an employee of the company at the time you make your investment either. Once you've made the investment and the shares have been submitted, the shares have been issued, then you can become a paid director of the company, providing your directorship and the payment that you receive is appropriate for the services that you're providing. Then that doesn't preclude you from being an EIS investor. As I say, it has to be a reasonable rate. So no £10,000 for 1 hour a week or something like that.
Yeah, 10,000 in and then 10,000 straight out again. Yeah, wouldn't wash, would it? No.
That's exactly what the prohibition is there for. It's to stop you from getting your investment back in a different form. Your capital still has to be at risk. So again, as I say, providing you're being paid a reasonable remuneration for the services you're provided, you can become a paid director of the company after your investment. The only issue with this is that you then, once you've become these are what are known as the business angel rules. Once you've become this paid director business angel, then you can only get EIS treatment for future investment for the next 3 years. So if you're doing follow-on fundraising, that's fine within 3 years. But then after that 3 years, you are precluded from further EIS investment.
Okay. And
doesn't affect the EIS you've already accrued, relief you've already accrued, but just stops you from claiming further.
Right. Okay. So that's a good one to remember. So Roberta has reminded us that in the event of an ASA, which is an advanced subscription agreement, it doesn't convert until 6 months later, does it? That you can't claim the EIS or the SEIS until the conversion event has happened. So that might be a legitimate reason that the founder delays applying for the certificates, isn't it, if it's an ASA rather than just a straight equity.
The advanced subscription agreement is always the curveball that comes into an EIS funding round. But yeah, you're absolutely right, Roberta, and thanks for that. You pay your money under the ASA, but it doesn't convert until much later, and that's the point where you get the EIS investment, and that could spread across a different tax year, depending on the length of the ASA and the length of that investment round. Yeah.
So yeah, you can't claim the EIS until you've actually got the shares, can you? So
yeah.
Question from Tracy: how far back can you claim income tax relief on SEIS and EIS?
Let me interpret that question in 2 ways, and hopefully one of them will be the right way. As I said, you can claim tax relief in the year of the investment and the 1 year prior to that date of investment. You have, I think it's 4 and a bit years from making the investment to actually make your claim. So if you've got an EIS claim, an EIS investment that you didn't claim tax relief for, you can claim it up to 4 years after the investment, but it still has to be relevant. It still has to be claimed in the year that you made that investment. So if you had an investment in 2019 that you haven't claimed tax relief for, you can still get you can still submit your claim for 2019, but it would still be a tax claim in 2019. You can't carry the relief forward and claim it in a future tax year. I hope one of those answers is correct. Is the answer you were looking for, Tracy?
I think it's the latter, but she's had both, so hopefully all covered. And if you haven't claimed upfront relief, can you still get the CGT exemption?
Well, no. The CGT exemption is dependent on the income tax relief.
Okay.
So you have to claim income tax relief originally. Now, it can be quite complex if people don't have the income tax liability. So you'd need to have at least something to set it against. Even if you can't cover the full amount, you have to have something, and at least make a partial claim in order to get the exemption on the end. As I say, the thing is, you do have the ability to carry it back. So you can claim it for, you can set it against your income tax liability in the previous year as well. But yeah, exemption is dependent on an income tax claim originally.
And an income tax claim, even if it's just for a small proportion of the eligible amount. Yeah. Right. Okay. That's really interesting. And you know, if a founder came to you and they wanted help submitting their advanced application, advanced assurance, or submitting their claim, how much would they expect to pay, or is that hard to?
How long is a piece of string?
Yeah.
It really would depend. We would sit down with the founder. We'd look through their business. If it's a complex situation, then obviously we'd have to submit more information to HMRC as part of the application process. Straightforward applications, are it's on a time basis. So a relatively straightforward application, a low fee. Much more complex situation would be a higher cost. I'm hedging around because I don't necessarily want to put a number on it, if you don't mind. But happy to sit down with any entrepreneur.
The first chat is free, isn't it? And then you'll be
Absolutely.
able to give them an indication of the cost. And
Absolutely,
prices are very modest, aren't they?
That's how we operate. We're happy to sit down, have a no fee introductory conversation and call with anyone, and then we can assess their need for an ongoing relationship.
Okay, and we've had a question from Kiki, which kind of touches on what I was talking about before about liquidation preferences. So is it only shares, ordinary shares, that will be eligible for SEIS or EIS? I know we need to take the conversation offline about this specific deal, but just in principle?
In principle, yes. It should be that it's ordinary share capital. So there shouldn't be any connected preferential rights to an EIS investor. There might be ways of structuring a preference on exit, but you have to be very careful and make sure that the situation is acceptable to HMRC. But generally, you're looking for ordinary share capital ranking alongside all other shares and equally at risk.
Okay, and now we're getting into some real nitty-gritty. Thank you, Mark. Susan again. She has said that some EIS shares can be traded on secondary markets, or sold in a partial cash exit. Does that preclude future participation in EIS rounds? So if you buy on a secondary market, they won't be EIS eligible because it only applies to new shares.
That's absolutely right. Yeah, it has to be newly issued share capital in order to qualify. So secondary purchases do not qualify for EIS. But I don't see any reason why, if a company has sold some shares, or sorry, if a company allows shares to be sold on a secondary market, I don't think the company should be precluded from raising further fundraising on newly issued shares going out to the market. Obviously, it depends on which markets they're using. The company has to be an unlisted company, so it can't be on recognized stock exchange. Generally, that's upper listing rather than lower. So there are you need to check which markets are actually the company's using.
Yeah. I think quite a few companies giving away bonus shares to investors at the moment, just to kind of avoid down rounds or compensate investors for down rounds and things. And I think if you have participated in a non-EIS qualifying share purchase, so a secondary share, you then can't, as an investor, claim EIS on future investments into that company, even if it's an EIS qualifying round. Is that correct?
So if I buy non-qualifying shares, you can, if you buy non-qualifying shares, you can subsequently buy qualifying shares from that company, providing you're buying them direct from the company.
Yeah. Okay.
So yeah, I've bought. I can say from personal experience, I bought shares on a secondary market. One of the crowdfunders bought them on a secondary market and then qualified for EIS on a
investment.
On a subsequent investment round. So yeah.
Okay. All right. Well, that's good to
The one
know.
thing,
There's quite a lot of misinformation going around, and
the one thing you do have to be careful of is obviously on subsequent sale, you are disposing of some shares that are taxable because they were acquired on a secondary market, and some shares that will be tax exempt. So you'd need to work out what your gain is, and how you can and what tax you need to pay on the exit, because only some of them will be exempt.
Keep it simple, just stick to EIS. And we've had another question from Roberta. So is EIS or SEIS available to a company who's acquired IP from a different company, e.g. IP developed partially and bought into the new co, then developed further? I mean, EIS and SEIS is only available to individuals rather than to the company, but
I don't see that would preclude the company from being qualifying. I guess the question would be whether or not they're acquiring the trade, and whether the trade history moves with the company, and therefore, if it's certainly for SEIS, it's the trades that needs to be less than 3 years old, not necessarily the company. So if an entrepreneur has been developing the trade privately and then incorporates, the history of that trade is attached to the length of time that the company can seek SEIS funding. So you'd look back at the whole 3-year period, even prior to incorporation. So that's one factor that you would need to potentially take into account. The acquisition of IP, I think, is a legitimate use of EIS funds. So I don't see that it would be precluded it would stop a company from qualifying if it used money to acquire IP.
Okay, sounds good. So just a couple of wrap-up questions. what are the typical problems that arise in claims?
The typical problems for a company or for the investor. I mean, for the company, it's generally not submitting all of the information to HMRC in one go. So HMRC's processing times for EIS are reasonably good, providing you give them all the information all at once. If you fail to send in everything that they need to process the claim, then it's just protracted correspondence, and that causes delays. And ultimately, the investors are sat on the sidelines waiting for their investment certificate to be issued, and getting frustrated that they're not able to make their tax claim.
Okay, and then wrap up question. I think we've done all the other ones, so thank you everyone for your questions. But do tax reliefs apply to dividends as well, or is it only exits?
Dividends paid by an EIS company are fully taxable, as if they were coming from a FTSE 100 company, shall we say. The exemption only applies to the capital gain realized on the exit. So yeah, frankly, most EIS companies don't pay dividends because the cash is needed to reinvest and to grow the business. But in the circumstances where an EIS company does pay a dividend, it's taxable income.
So I suppose that sort of informs us as investors. It's these are directed at high risk, high potential reward investments, not safe businesses that will be earning money and growing slowly and able to pay dividends. So okay, well look, that is very helpful. And Mark, you've said before it's okay to put your email address in the chat. So Michelle is kindly going to do that for us so that Nikki can follow up, and anyone else if they've got any questions. So that's the de minimis state aid question. But thank you very much, Mark. Really, really helpful session as usual. Thank you for your time. And just if everyone could stay on the line for a couple more minutes, I just want to talk about kind of next steps. See you soon, Mark.
Thanks very much, Sarah. Goodbye, everyone.
So if there are any founders on the call and they would like to apply to pitch to us, please do it via our website. It's the quickest way onto our radar. We don't require warm introductions at all. We look at every application. If you'd like to join us as an angel investor and come along to our monthly pitch events, please email Michelle for more details. And we'd love it if you subscribe to our newsletter and followed us on LinkedIn. And last link on this slide is we've done lots and lots of these sessions previously. You can find recordings for all of them on our YouTube channel. So it's a fabulous resource of various aspects of angel investment, both for founders and for investors themselves. And my last slide is about next month's event. It's going to be our first event with DC Advisory, who are our new partners. They are an investment bank focusing specifically on the mid-market and up. So the mid-market is Series B onwards. And they, in our first session, are going to be discussing tech and software valuations. That's something that we're often asked about. So that should be a fascinating discussion. So I hope to see you all there, if not before. Thank you very much for joining us this evening. Thank you for your excellent questions. I hope you have a lovely evening and see you all again soon. Thank you.